learn about foreign currency transactions. So we have two chapters back to back. One is about transactions and another is about translation. Right. So transaction is very simple. Right. You are buying or selling products or goods or services, and you have some foreign currency exchanges. On the other hand, in chapter 10, we're going to learn translation. Translation means what if you have a foreign subsidiary that they are doing their financial statement using Mexican peso, but when you need to do the consolidated financial statement, you need to convert those peso financial statements into dollar before combining these two. That we're going to learn in chapter 10. Right. But let's focus on this chapter. Right. So, today the world is totally globalized. You just cannot think of doing business within USA. You may have your customers outside of your USA or suppliers outside of your USA. Sometimes you may feel that buying raw materials from China would be cheaper. You could do that. Or selling goods to European, African, or Asian market is also profitable, right? And that's why you will have several types of international transactions, global transactions, right? Especially for any multinational company headquartered in USA. But you will see that those type of transactions may not happen in dollar denomination, right? Say, for example, you want to sell some of your products to an European customer, and that customer will pay you in euro. So what are you going to do with euro? Nothing. You have to convert those euro into dollar. So now when you're going to convert those euro into dollar, you will see that the exchange rate may not be same every time. Right? Is there an international student outside from USA? Or do you know any currency, any foreign currency's transaction rate? Mexican peso. Or Google it. Tell me, $1 is equal to how much peso? What's the currency of China? What's the currency of China? Yen. Yen equal to how much dollar? Or $1? What's the exchange rate?
88 cents.
88 cents. Okay, $1 equal to 88 euros. Cents, right?
Yeah.
Okay, very good. And you see this graph? It's not fixed, it's fluctuating, right? Now you check it's 88 cents, right? 88 euro, 0.88 euro per dollar. Maybe tomorrow you will see it's 0.98 euro. Or it could go lower. That means depending on the demand and supply or economic condition of a specific country, their exchange rate can vary. And that's why you will see that $1 versus any foreign currency's rate is not fixed. It always fluctuates. But when you are doing business with your foreign parties, you may need to face this type of risks. Right. And you may need to face any type of gain or loss just because of these foreign currency fluctuations. It's not you're under control, right? Still you may need to report that gain or loss. Right. So usually in real world, what companies do, they do hedging. They take kind of insurance type of protections. But here we'll not go for the hedging. Rather, we'll just see if you need to face these type of transactions, and especially if you have any gain or loss, how you're going to record it. And here you will find only piece of journal entry. Right. So now let's see this example. Here you will see that if you do any sales, right, that means you are exporting. When you make sales, what are you going to expect? Sales. Your customer will pay you. Right. If your customer pays you in foreign currency, then you have to sell those currency to make it dollar value. Right. Now, you are expecting, try to understand, make your own concept, your own tree. You are expecting to receive euro. So what would be your expectation? You will expect that the euro value should go up. Right. Then in terms of dollar, you will make more dollar. Right. That means if you are expecting to receive euro, you will expect euro appreciation. Appreciation means that the value will go up. Right. Foreign currency's value will go up. On the other hand, depreciation means the foreign currency's value will go down. So when you have to receive foreign currency, definitely you'll expect the value should go up. That currency's value should be appreciated. On the other hand, if you need to pay foreign currency, say for example you bought some raw materials from China and you have to pay this Chinese yuan, so you expect that the yen value goes down. Then you have terms of dollar. If you need to pay something, you'll expect to pay less. If you need to receive something, you'll expect to receive more. That's the human nature, right? And based on that, we're gonna calculate our gain or loss. So now here I have few concepts. I'm just giving you a little bit of idea. It's called one transaction perspective and two transaction perspective. We actually don't follow one transaction perspective in USA. For GAAP actually doesn't allow it. So one transaction perspective means that when you, let's take the example of sales. When you make a sales, the sales amount is not fixed until you collect the values, collect the foreign currencies. It can vary, right? But we don't follow it here in USA. Rather, what we follow two transaction approach or two transaction perspective. So let's try to understand this two transaction approach. So two transaction approach means that when you make any sales, you ship your goods to German, say for example German or any European country. The moment you ship your goods, it means that you earn the revenues. You have to record your sales, no matter when you receive those euros, right? So the day you ship your goods, you earn your revenues, you have to record your sales, and your sales is completed. So on that day's amount, you will record your sales. So sales will be recorded on the day when you earn it or when you make it. That's it. Sales amount will not be changed. Now, all these transactions are credit transactions. So when you're gonna make sales, definitely you will debit your account receivables. So what will change is your account receivable. So depending on euro and dollar exchange rate, you have to check and you have to do the adjustments with your account receivable. Right, that's called two transaction perspective. Now I can give you one purchase example. For example, you purchase some raw materials from India. Right, the day you purchase, you have to record all those transactions. The purchase happened, say for example, March 1st. Right, you bought some inventory, you debit inventory, you credit accounts payable. Right, you remember all these basic entries, you are not paying cash to your Indian supplier. So you credit accounts payable, so the day you purchase, your purchase is complete. Right, but what the changes will be happening, all will be adjusted against your accounts payables. Right, so definitely you have to record your foreign exchange gain or loss, but that will be adjusted against your accounts payable or account receivables. Right, that's called the two transactions perspective. Now let's see a little table, nothing to memorize, but try to understand it. Try to understand it. Export sales. That means if you sell to your foreign customers, right, what should be the journal entry? I already mentioned it. Sales. Who can tell me the journal entry? You sold to your European customers. Whatever you sold, what should be the journal entry? You have to record sales revenues. Your European guy is not paying you cash. Tell me the journal entry, debit, credit. You sold your product. Yes.
Debit, accounts receivable, credit, sales.
Excellent. So when you are an exporter or you are making a sales, you debit account receivables, right? Because you are not receiving cash. So you create account receivables and you credit sales revenues, right? Now, account receivables, what type of account is it? Is it an expense, revenues, liabilities, assets? Account receivables. Yes, it's an asset. So that means when you are making a sales, you are exposed to account receivables. That means your type of exposure is an asset. So you made a sales. You are expected to receive euro from your foreign party, right? You are expecting to receive euro. I mentioned the human nature is that if you expect something, definitely you will expect to receive more. If you need to pay something, you will expect to pay less. So that means you will expect that euro value should go up, right? So that means if your European customer will pay you in 3 months and euro value went up, in terms of dollar, you can make more money. You'll be happy. So euro value goes up means if euro appreciates, you will make a gain. On the other hand, in 3 months, European economy, they have Brexit, all these issues, euro actually went down. And in 3 months, when your European customer is paying you back, euro value actually went down, and you received actually less what you are expecting. That means because of the depreciation of euro, you are making a loss. Is that concept clear? Please try to have this concept. Find your own way how you will remember. Don't try to memorize it. Don't try to memorize mechanically. Right? But if you understand it, you will never forget it. But if you try to memorize and if you do little mistake, you will get wrong answers. So we just discussed here when you are making sales, exporter, you are exposed to an account receivables. You are expecting to receive foreign currency. So you're going to expect foreign currency value appreciates. You will have a gain. In case foreign currency value depreciates, you will have a loss. Now let's see when you buy, when you purchase. Right. When you purchase, what should be the journal entry? Say, for example, you purchase inventory. You purchase inventory from China. Of course, it's on account. Credit purchase. What should be the journal entry? You purchase inventory from China. You are not paying the cash now. You have to pay it later. You purchase inventory from China. Accounts payable, very good. You purchase inventory, so you have to debit inventory, what you purchase. And then you have to credit accounts payable, right, Noah? So accounts payable, what type of account is it? Accounts payable, is it an asset or liabilities? Sam? Liabilities, right. You have to pay. When you have to pay something in future, you're going to expect, what if I would pay less? Then you'll be happy, right? That means when you are making any purchase, you are creating an accounts payable and you are exposed to a liability, so you want to pay less. And in that case, if foreign currency value depreciates, you will be happy. If foreign currency, if Indian rupee, they call it rupee, depreciates, then you have to pay less and you will make a gain, right? So that means when you are importing or you are purchasing from any foreign currency, you created an accounts payable and you are exposed to liabilities and you have to pay. You have to pay your foreign party, foreign supplier. So if you have to pay less, how can you pay less? Only if your foreign currency value goes down. So that means if your foreign currency depreciates, you're going to make a gain. On the other hand, if foreign currency appreciates, you will make a loss. Right, that means if Indian rupee value goes up, that means in 6 months when you're going to make the payment, you have to pay more dollar, which is not good. Right, that means if foreign currency appreciates, here in this case, you may have to face a loss. Although in real world, companies will do hedging, but now we will learn how we're going to record the transactions. Right, so this table is clear. I'll have multiple choice question when we're going to play the game. So you can take note, you can check it, and you have to understand it. Don't try to memorize anything mechanically. Now, for this chapter, the only few journal entries. And that's for those who really love journal entries, especially for exam 2, will be helpful. Let's try to do the journal entries. I just mentioned that we follow 2 transaction approach. The 2 transaction approach means that when you make any sales, your sales will be done on the day you ship your goods. Right, you earn the sales. That's it. Your sales amount will never be changed. What the change will happen here, the amount will be changed, which is account receivables. Same thing for your purchase. When you purchase anything, whatever the change will happen here in your accounts payables. Right. So now let's take the example. And remember, you are US company. You are a US company. Definitely will record everything in terms of dollar value. Your transaction could be in terms of foreign currencies. So let's read this example. Americo company on December 1st, they sold inventory to a German corporation, 1 million euros on credit, and America expects to pay this euro in 90 days. The current exchange rate is that 1 euro is equal to $1.32. So America actually shipped the goods or sold it on December 1st. So the actual sales must be recorded on this date. So when you're going to record it, you will debit account receivables, you will credit sales. And this transaction is actually in euro, but you're going to record everything in dollar. So you know 1 euro equals to $32. So 1 million euro means $1.32 million. So on December 1st, you're going to do this journal entry. Is it clear? This journal entry, everything will be recorded in dollar value. I'll give you the exchange rate on that specific day. So now, what you have to do at the end of your each fiscal period, you have to check what is the exchange rate. Although the transaction is not complete, because here the euro will be paid in 90 days. Right, that means sometime end of the month of February or early March, right, in 90 days. But on December 31st, you usually close your books. Right, so when you're going to close your book, you have to check what is the exchange rate between euro and dollar, and you have to calculate your gain or loss. Although the transaction is not completed, still we're going to do it. So on December 31st, we found that 1 euro means $33. So now, who can tell me whether euro actually appreciated or depreciated? In our previous example, let me write down the date. December 1st, here 1 euro was $32. Now at the end of the year, when you are closing your books, December 31st, 1 euro is equal to $33. So the value of euro went up or down? Up, right? So you have to understand these things, right? Just try to think of euro as a commodity like an apple, orange, whatever. So if you want to buy 1 euro now, you have to pay 1 cent more. So euro value actually appreciated. So now you made a sales. You are expecting to receive euro, and euro value went up. Euro value appreciated. Is it a good sign for you? Will you be happy or sad? Happy, right? Because doing nothing, you are making 1 cent gain from this euro. So now at the end of the period, when you are closing, you have to record the gain. So definitely it's a gain, and you know how to calculate it. You just need to take the difference, right? 32 cents and 33 cents, 1 cent gain per euro. And you had 1 million euros. So 1 cent times 1 million, that means your total gain is $10,000. Are you kidding? $10,000 just doing nothing, you are making a gain, and that will affect your net income number. Right. So now how you will record it. So in terms of your account receivable, since euro value went up, you are expecting to receive more in dollar. So your account, bless you, account receivable will go up, and you have to record a gain. Right. So account receivable, you are now expecting to receive more. So we increased account receivables, which is debited, and at the same time we recorded the gain. We call it foreign exchange gain. Is it clear? So when you are closing your book, you have to check whether you are making a gain or loss. Right. Now, what's happened in 90 days, which is March 1st, that European guy actually paid you 1 million euro. The deal is done. You collected all 1 million euro. What you gonna do with euro? You will go to the foreign exchange market, you will convert those euro into dollar, and you will convert those based on that day's spot rate. Spot rate means what is the exchange rate on March 1st? And you found that March 1st, your 1 euro is equal to $33. Now you again need to check your gain or loss. And now what you're going to do, you will compare this March 1st rate with your immediate adjusted rate. That means your last adjustment was on December 31st. So compare December 31st and March 1st rate. Right, remember, what you already adjusted, it's done, it's already reflected. So compare this March 1st rate with your immediately adjusted rate. That means December 31st. So December 31st, 1 euro was $33. March 1st, 1 euro is $30. So what happened to euro? Euro value goes up or down, Jake? Down, right? You are expecting to receive euro, and that value goes down, right? That's not good for you. So these 3 cents you are losing here. These 3 cents you are losing doing nothing. You have to show this. And of course it's a loss. Loss is always a debit item. So you're going to debit foreign exchange loss. And you are expecting to receive less. So you need to reduce your account receivable value. Right. So you have to calculate the amount that you are losing apparently, right? And that is 3 cents per euro, and you have 1 million, that is $30,000. You see here, now you are facing this huge amount of loss just in 2 months because the euro value actually depreciated, and you have to face this loss, right? Your account receivable amount actually changed. But that's not for your fault, and that's why in real world companies, they locked in some exchange rate and they protect themselves. That's called hedging. Right, now let's do a T account for account receivables. I love T account, so it shows like all reflected changes. So when you created account receivables, this is December 1st. So December 1st, your account receivable amount was 1,320,000, all are dollar values, right? And then at the end of the year, December 31st, you checked your exchange rate and you found you made a gain. You debited your account receivables, right? So December 31st, your account receivable was 10,000. Of course, you're gonna take the balance and you will take the balance to next year. But I'm just showing only the account receivable part, and I'll show you what should be the balance after doing all gain or loss adjustments. Now on March 1st, you lost $30,000 because your euro value depreciated. And at the same time, you reduced your account receivables. Right. So what is your latest account receivable balance? Who can tell me? Here. What is the account receivable balance after doing these 3 journal entries? Mike and Anthony, help me, please, save me. What is the account receivable balance here?
1,330,000.
330, 1 million, take it again. You added this 2 and then you subtract this 30.
300,000.
300,000, right. That means after adjusting or gain or loss, your account receivable should be 1,300,000, 1.3 million. And now on March 1st, when you received all of your euro, you will go to the foreign exchange market. You will convert those euro into dollar, right? Exchange rate is 1.3. You will get exactly like 1,300,000. You received all of your account receivables. You debited cash. You credited account receivables. So I'm gonna credit account receivables. So the deal is done. We don't have any more account receivables. So you see, this is called the 2-transaction approach. Your sales never change. Whatever the sales amount was here, it is not affected at all. So your sales amount will be like this, right? Your sales revenue is not changing. Rather, because of this gain or loss, your account receivable amounts are changing, and whatever was the latest balance, and because of doing all these adjustments, if you convert all those euro, you will get the same balance. The account receivable is closed. So is it clear, this example? I just gave you the example when you are an exporter or purchaser. Oh no, sorry, the sellers, right? Now we will do some exercise problems, and definitely get ready for the game. For these exercise problems, we will practice the only few journal entries that we have here for this exam. We will practice some journal entries, and we're gonna calculate all of our foreign exchange gain or loss. Let's do 4 quick problems. So I pass the sheets, and we will do 23, 24, 25, 26. Very quick. You have your calculator ready. we just did the problem with sales example, but I think you can do all if it's an importer's perspective or buy. So can you do problem number 23? So 23 asks you to calculate just the gain or loss. Remember, you actually calculate this gain or loss on 2 days. One day, when you close your financial statements, usually the date is December 31st, and another when your transaction is completed. That means when you collect your payment or you make your payment. So on these 2 days, you have to calculate foreign exchange gain or loss. So think carefully whether you are selling or buying, whether you are expecting to receive foreign currency or to pay foreign currency. Turbo Corporation, a US-based company, they acquired, that means you purchased some merchandise on account from a foreign supplier on November 1st. And that's 100,000 markers. Markers, that's foreign currency's name. They paid all those markers on January 17th, but in between you have December 31st. So when you are on December 31st, you're going to check whether you are making a gain or loss. Remember, you purchased, you acquired. That means that creates what? Accounts payable or receivable. When you buy on credit, it creates an accounts payable. That means you have to pay all those foreign currencies in future. Now what happened to this marker's value? Marker's value actually goes up or down. This is one marker against the dollar. Who can tell me if you compare November 1st to December 31st? Yes, Kyle. It went down, right? So if you take the difference, it went down, right? 0.012 cents, right? So that means if you take this difference, 0.754 minus 0.742, this is for par marker. So it went down, and the total marker sees, I'm trying to squeeze it here, 100,000. So now it went down. This is the whole amount. Everything we are converting into dollar. Now you are supposed to pay, right? Because you acquired. You are supposed to pay these markers. Value goes down. So are you making a gain or loss? You are supposed to pay. You are supposed to pay some foreign currency. And that foreign currency value actually goes down. Gain or loss? Gain, right? If you need to pay and you have to pay less because the value goes down, then it's a gain. So what's your gain? If you tell me the number, please. It's 1,200. So again, try to apply your concept, right? Remember, here you are exposing to an accounts payable. You have to pay. Whatever you want to pay, the value goes down. So you are making a gain. So this is important. You know, numbers, you can figure it out. You can do the numbers easily. But make sure you label it correctly. It's a gain or loss. Now, on January 15th, you actually paid, right? You paid all these 100,000 markers. Now we're going to do another adjustment. And you have to tell me, based on January 15th versus December 31st, the latest adjusted date exchange rate, whether you are making a gain or loss from here. Tell me, marker's value went up or down based on the last two exchange rates. Goes up or down? Up. Now you are paying. You have to pay something, value goes up. Are you going to make a gain or loss? Loss, gain? So what's your total loss? Well, tell me. Just take these two numbers. It's a little bit hazy, but you can check your own note. So I can read clearly from here. It's 0.005. So you you can subtract it. So 0.747 minus 0.742 and multiplied by 100,000. And James thinks it's a loss. Yes, of course it's a loss. The value actually went up. Right, Marcus value went up by 0.005 cents. So you have to pay more. It's a loss. So what's the number here? It's $500. So you are making $500 loss. So the question is how these exchange rate fluctuations will affect your 17th and 18th income statement. So for 17th income statement, which is here December 31st, you will have a gain. So it will increase your net income number. On the other hand, on 18th income statement, you are recording a loss, so it will negatively affect your income statement number. So you just need to calculate the gain or loss from here. Right. Is it difficult or all of you got it? Everyone got it? Anthony? Let's see here. Kyle, Joe, Noah. Got it? Okay, let's do next one. We'll just calculate gain or loss. And for the other two problems, we're going to do the journal entry. Okay, let's calculate it. Jack will tell me this time, number 24. First check whether you are buying or selling. That means whether you have to pay the foreign currency or you have to receive the foreign currency. If you need to pay, definitely you will expect the value goes down. Then you have to pay less. On the other hand, if you need to receive, so Butana Corporation, U.S. company, Miami, Florida, sold. So they are selling. So they created an account receivable. Ostras in the foreign currency. And the transaction happened on December 20th. December 31st, you close your account. So now this time you will receive. So when you're going to receive, you will expect to receive more. Right, so you will expect to receive that the Ostras value will go up. But what happened here? Jake, if you compare December 20th versus December 31st, this is one Ostras equal to $0.05. At December 31st, one Ostras equal to $0.02. So Ostras value actually goes down or up? Down, right. Now you are expecting to receive Ostras. You are hoping to receive something, the value went down. So will you have a gain or loss? Loss, you will have a loss. So how much is your loss? I'm writing it here. You have to take the difference and multiply it by the whole denominator. What's that, 50 or 30,000? 50,000, right? It's 50,000 Ostras. So what's your total loss, James? 1,500 is a loss. Remember, now this time you sold, you are expecting to receive Ostras, and the value went down. So we'll have a loss, and that's 1,500. Right. Now again here on January 10, when actually you made the payment. When you made the payment, it's January 10. You have to buy all those Ostras. Oh no, you don't need to make a payment. Actually, you receive the payment because you sold it. So when you receive the payment, it's January 10. You received 50,000 Ostras. You received all those Ostras. Now check this last two exchange dates, January 10th and the recently adjusted date. Compare these two and tell me first whether the Ostras value goes up or down. Ostras value goes up or down. Again, it goes down. Right. Now, you are receiving those Ostras. The value kept going down. So if you compare these two rates, last two rates, are you making a gain or loss? Gain or loss? Everyone, gain or loss? No, a loss? So tell me what will be your total loss. December 31st, one Ostra was $0.02. January 10th, one Ostra equals to 98 cents. So you are actually making a loss 4 cents per Ostras. right? So what's your total loss? Okay, so you have to multiply it by 50,000. That means your total loss is 2,000, right? The numbers are easy, but make sure you label it correctly. It's a loss. Is it okay? This one is fine? Okay, very good. Now, we'll keep doing, we're going to do number 25 and 26. This time we'll do the journal entries, and that's the only journal entries you will have. Those who love journal entries will be happy. Even those who don't love journal entries will be happy because this is very simple journal. Let's read 25. So US company, Peerless, they made a sales to a foreign customer. Let's look at the date, September 15. They made a sales, they sold. The foreign currency's name is crowns, 100,000 crowns. And it received the payment on October 15, and they actually closed their book on September 30th. Okay, usually it's on December 31st, but they mention it, they closes their book on September 30th. That means on 30th, we're going to calculate the gain or loss. We'll adjust it, and then again, October 15th, we'll do it again. Right, so let's try to do the journal entry quickly. So someone will tell me what should be the journal entry on September 15th. Quicker. September 15, when you actually made the sale, and everything will be in dollar value. So someone save me please, September 15, what should be the journal entry? Ashley actually mentioned it. If you made any credit sales, what should be the journal entry? I erased it.
Debit accounts receivable, credit sales.
Debit account receivables, credit sales. Right, or sales revenues, even only sales is fine. Very good. On September 15, you made these sales. The sales are actually in crowns, 100,000 crowns, but you know the exchange rate. So what should be the amount here in dollar value? Because we're going to do everything in dollar. So 1 crown is equal to how much? On September 15, 1 crown is equal to 60 cents, and your total sales actually is 100,000 crowns. So what's your total number of sales?
8,000.
Very good. So on September 15, we're gonna record our sales revenues, and that's it. Your sales revenue will never be affected or changed because of these exchange rate fluctuations. Rather, we will adjust our accounts receivable. So that's September 15th journal entry. Very good. Now we close our book on September 30th. September 30th, and on that day, we're going to calculate gain or loss. Remember, you made a sale, so you are expecting to receive those crowns. Check these two rates. Take these two rates and tell me whether you are making a gain or loss.
Gain.
You are making a gain, right? Why? Because you are expecting to receive the crown. So crown value actually goes up against dollar. Now to buy 1 crown, you have to pay 6 more cents, right? So crown values actually goes up. Since you will receive those crowns, so you are making a gain. So now you have to record the journal entry for gain. So gain, that means you are expecting to receive more. So you have to increase your account receivable value. Increase your account receivables means you have to debit account receivables or credit account receivables. That's good. Increase your account receivables, which is an asset. You have to debit it or credit it. Debit, right? The regular balance is debit, so to increase it, debit it. To decrease it or remove it, credit it. So we're going to debit account receivables. At the same time, Ashley helped me that we made a gain. You are receiving more in terms of dollar, right? So we will record gain. Gain is always credit. Remember, we always credit gain and we always debit loss. So you can write it down, foreign exchange gain. and someone will tell me the number. So the difference per extra is 6 cents, right? And total amount of ostras 100,000. So what's the value? It's actually $6,000 gain. So in terms of dollar, your account receivable will go up by 6,000 and you have a gain 6,000. Very good. Is it clear? Everyone did the journal entry? Everyone did it? Conrad, you are here? Okay. Now tell me when you actually collected all those crowns. And that's on October 15th. So on October 15th, that foreign guy actually gave you all these crowns. You received these 100,000 crowns. So first you need to do 2 journal entries. Remember, first you have to check whether you are making any gain or loss based on these 2 dates exchange rate. Then you have to record the collection of the cash. So first check the last 2 dates, because December 30th we actually adjusted it. Then October 15th, check these 2 rates. 66 cents and 62 cents. Crowns value actually went down. So you are receiving crowns and the value actually went down. Are you making a gain or loss? Here, 66 and 62. It went down to 62. Are you making a loss or gain? You are making a loss, right? So if you need to record a loss, you usually debit it or credit it. Loss. Debit it or credit it? Debit. Debit. Loss is always debit. Very good. And at the same time, you are expecting to receive less, so you have to reduce your account receivables. So I will debit foreign exchange loss, and at the same time, I will reduce my account receivables, right? Because now we are expecting to receive less, because all those crown values actually went down. Now remember, you have to compare with today's exchange rate versus the recently adjusted rates. That means 66 cents per crown versus 62 cents per crown. So for each crown, you are actually losing 4 cents and your total amount is 100,000. So in dollar value, your total loss is 4,000. So you're going to debit foreign exchange loss. Remember, loss is always debit. And at the same time, you have to reduce your receivables because you're going to receive less, which is also 4,000. Now, on October 15th, you need to record one more journal entry. That journal entry is for receiving the cash. So you collected those crowns, you converted those into dollar. So you got the cash, right? And you have to remove your account receivables. What should be the journal entry? The last one. You received cash and you remove the account receivables entirely. What should be the journal entry? You received cash. Tell me something, debit, credit. Someone else who didn't talk today. You received cash, Noah. Debit what? Debit cash. And you collected all of your receivables, so remove the receivables. So the last journal entry is the collection of cash. So we're going to debit cash and we will remove our entire receivables. And if you check the balance, you will see the same amount, whatever the receivable should be, based on October 15th value. So on October 15th, your exchange rate is actually 62 cents per crowns, and you have 100,000 crowns. That means in terms of your dollar value, your receivable should be 62 cents. Or even if you do a T account, you will also find the same account receivables value. Right. That means we're gonna remove these account receivables entirely. So we got this cash, we got the crowns, we converted it into dollar, we got this cash, and at the same time we collected our account receivable, so we remove it. Is it difficult, Anthony? Hi, Joe. This side. Everyone is fine. Conrad. Jake? Simple, right? Simple like water. So now I know we have a time to break, but we keep patient. Spend 5 more minutes and do the next one by yourself. Do it in a group. Remember, we just did the sales. Now this time you are purchasing. So when you purchase, you actually credit accounts payable. I believe the next example is for purchase. So far, you see the sales example, but I believe you can do the purchase one. So within a group, please do the journal. And thank you. And then I promise we'll take a break, and after the break we'll play the game. We are on time because I have a long list of agenda, but I believe we should be fine to finish all these things. Number 26 is purchase. So please do it by yourself. And match answer. You are purchasing inventory. When you purchase something, you actually credit accounts payable because it's a credit purchase. You know, this problem has one extra date. Don't be confused. Our transaction actually completed on January 25. So this is an extra information. January 31st rate, we don't need to use it. Sometimes the problem may give you some useless information. Don't be confused. You are almost 100% in class. So when you are in class, my sincere request, pay your attention, do your work. I can see like some of you do other coursework. Some of you just do browsing. I can see everything when I walk around. But please be sincere, pay your attention, learn everything in class. That will be for your benefit, I promise. Please. Yeah. You did it? You did it? Do it. Don't wait for me. I know you did it. Okay, you will help. Okay. You purchase, right? Don't wait for me, please. Match it with your group mates. We're gonna play the game right after our break. I mean, we'll take a short break, 10-15 minutes. It will be fun. You will have some award and prize. So, who can help me? Conrad, let's just start from here. What should be the journal entry? You are purchasing inventory on credit on December 15th. Yes.
Debit sales 14,000 and credited accounts payable 14,000.
David, actually, what? You purchase inventory. Conrad. Yeah, you receive inventory. Your inventory is going up, right? So you have to actually merchandise inventory or only inventory, whatever you call, you have to debit inventory, right? And you have to credit what? Conrad again. Very good, thank you. Accounts payable. Now tell me the number. It's shilling. The foreign currency is shilling.
14,000.
You got 14,000. How did you get it, please?
50,000 times
28 cents. That's for per shilling, dollar amount, and total is 50,000 shillings, right? And you got $14,000, right, Conrad?
Yeah.
Thank you. Next, check. December 31st. You need to check the gain or loss. So now you purchase. Purchase means you have to pay. Right. Check the values. Ceiling value goes up or down. You have to pay this time. Values goes up or down. The point. Up. You have to pay that, but the value goes up. So will it be a loss or gain for you?
Be a loss.
It's a loss, right? You have to pay more. So if it's a loss, loss will be debited or credited. So can you tell me the journal entry, please? It's foreign exchange loss. Very good. We'll do every adjustment. Credit accounts payable. Our accounts payable is going up. It's a credit item, so it's increasing. You have to pay more because shilling is doing well. Shilling values is going up. Now tell me the number. Sam or Christine will tell me the number, the loss amount. How do you get it, please? 0.3 minus 0.28. That means 2 cents per times 50,000. And you got it, $1,000 loss. Excellent. Is it clear? Everyone, please try to understand. Learn everything in class. Now, Anthony or Mike will help me to do January 25th gain or loss. Because on that day, you actually collected, your foreign guy actually paid you all those shilling. You collected your payment. First, you're going to record gain or loss. Then we're going to record the collection. Yeah. Who wants to take the lead? Anthony or Mike?
So, foreign exchange loss.
So you have a loss, a gain or loss, because its value is again like going up. If its value goes up, you have to pay more. So it's a loss, right? Very good. Go ahead. Journal entry, debit, credit.
Debit.
Very good. I'm going to debit foreign exchange loss.
Accounts payable.
Yeah, now you have to pay more. Accounts payable. So tell me the number. Joe or Kyle will tell me the number. How do you get it? Yeah. 0.33 minus 0.3. So you're going to compare these last two dates. Remember, you have an extra date. Don't be confused. You don't need to use the last information here. So it's 3 cents loss, and you have total 50,000. So what's your total loss? Here, Sam, James, Nicole. What's your total loss? On January 25th. It's 1,500, James. And at the same time, you have to pay more, so you are increasing your accounts receivable. 1,500. Nicole, you got the same numbers. Very good. Now last row will tell me Noah, Victoria, and Gianna. The last item. That means you are paying your cash. Oh, you actually purchased. So this time you're gonna make the payment. So you pay all of your shillings. You pay cash. And you have to remove your account receivables. What's the journal entry? Last line. Last row will help me. You pay cash. Very good, Gianna. So all of your accounts payable are paid, so you remove it. Accounts payable is a credit item. So we are removing it, so we debited it, we paid cash. Cash is gone, so we credited cash. And that will be based on January 25th exchange rate. So who can tell me the number? Here, Noah or Elisa? I'll come back, Jared and Elisa. Or Liam here. Tell me the number, please, then we'll take a break. 16,500. How did you get it, please? You did the accounts payable numbers? Yeah, very good. There are two ways. You could do a quick T account for your accounts payable. It was 14,000. It kept going up. 1,000. 1,500. So your accounts payable will be 16,500. And when you pay it, you have to remove it. Very good. I'm happy that you use the T concept. Or on the other hand, you can also take what is on January 25th rate, which is 33 cents, and your total amount is 50,000. and you will get the same number here. Right, there are two ways to get the last number. Because we already adjusted accounts payable, so it will reflect today's January 25th number. On the other hand, what Noah did actually these T accounts and check the balance that you're going to collect, that you're going to pay your cash. Right, is it clear? Is it clear? So now let's take a quick break and we're going to play some game. Give me some polling, but the game will be more fun. Okay, and the game will be based on all these journal entries, all these little concepts, and multiple choice, but you can take your notes and everything. Please take a break, 10-15 minutes, and then we'll be back.